And good afternoon from a perfect day of weather in Houston, Texas. My name is Randy Price. We are the Price Group. We're thrilled that you have made time to join us for what we call our education and communication process. We love to have details of interest, perspective to clients, as well as folks that are not currently clients. And we do this one way through our monthly market update. Obviously, November, Thanksgiving is next week. Hard to believe, but here we go. We'll try to move along in about 20 minutes or so. If you have questions in the appropriate place, you can send those on to us or contact us afterwards by phone or by email, and we'll make sure to get your question answered. Who are we? Family owned and operated business. Very fortunate to work with Matt Price and also Maddie Kearns, 50 plus years of experience. The important thing, we are a fiduciary and we are in the retirement area. 83% of our clients are retired. Several others are close to retirement. And so that's our area of expertise and what we work hard to do well at. Thought we'd start out by talking a little bit about what has been on everybody's mind, the election, where we go, what are some of the things that are going to happen, how will that affect the stock market, the bond market, so on and so forth. Some of the things that incoming President Trump can do to implement his policies, some through executive orders without congressional approval. Immigration and border security, trade, deregulation, which is, I think, the sleeper of the group, as well as foreign policy and some of the decisions there. We hear a lot of questions and read some articles about trade policy, tariffs, and trade deals, and how this is going to be super inflation for the market. Tariffs are going to increase expenses, and tariff rates from a historical standard remain low. Okay, and we think from the Price Group that this is more of a negotiating tactic, and we will not see a lot of inflationary pressures from some of those threats. Moving right along here, we can see that some policy priorities do require congressional approval. The big one, obviously, is the 2017 tax cut extension, expires in 25. National debt ceiling, and that movie continues on and on. Spending priorities, nobody's going to look at this chart on the right and say, "Oh, wow, that's great information, Randy," or that's news to me. But the debt ceiling, the national debt is at a record high and continues to move higher. And that's why so many people, I think, are really excited about the possibility of the new effort to rein in some of that spending. But some things will take congressional approval. Now that the Republicans control all three branches, supposedly that should be easier to do. So what are some of the potential impacts on the sectors? Or turn around the question, what sectors or industry will be most impacted, positive or negative, by the outcome of this 4-year election cycle? And this is performance following this past election day. We had the best performance in a day following the election. That's in history. That's the S&P 500. But you can see the financials and the small stocks have done extremely well. The industrials, someone would say, why the financials? There's a hope that there'll be some deregulation there. And there's a hope that there'll be some merger activity as the bigger fish perhaps look to eat some of the more medium-sized fish, and the medium-sized fish might look to eat some of the smaller fish. So anyway, real estate at the opposite end, very easy to explain there, and that's interest rates have moved higher. The 10-year Treasury bond today yielding about 4.42%. Rates have jumped up from where they were not too long ago, and so that's made mortgages higher, and that's put some pressure on interest-related stocks as well as fixed income. Fundamentals remain, we think, the long-term driver of the market, not politics. One of our recent weekly blogs, we talked about, who would, whether it was a Republican or a Democrat, had won the election. There was no pronounced difference. And so we think that the fundamentals, what are the fundamentals? Economic growth, the business cycle. Are we in a recession? Or are we in a growth mode? What will help is if people have more confidence in the system, more confidence in the government, more confidence in the rule of law, etc. Better chances of economic growth. The fundamentals. What does each company look like from their earnings? Are they guiding the estimate of their earnings higher? Really, when you get down to it, a stock is the present value of future stream of earnings, and that's what really the market looks at each and every day. What's their strength of the balance sheet, etc. Monetary policy. Hello, Federal Reserve. They've lowered rates by 0.5% and 1/4%. That's taken money market from about 5.3 to about 4.6. So money market remains a very good place to park money. Money market is not an investment. And, if the Fed were to cut a couple more times, and the president-elect does favor lower interest rates, that would mean that money market could be down into the low 4s or maybe high 3s. And what does that mean? Well, if you need cash as liquidity, if you need liquidity, great place still to hang out. If you're just not sure what to do, it's a little bit of a wake-up call to perhaps make a decision on which direction you take some of your cash. Number 4, interest rates and inflation. 5, valuations. 6, sentiment. Consumer employment, business surveys, corporate activity. How about this? Number 8, politics. 9, geopolitical events. And number 10, natural disasters. All fit into the investment strategy framework on how we look at the markets, stock market, the bond market, not so much politics, although again, politics, number 8, one part of the overall information considered. So potential sector impacts. Conventional wisdom does not always play out as expected. It's interesting. You have a big piece of the stock market is measured by the S&P 500 in the information technology, the tech companies, and the not exactly loved from a potential monopoly position by this incoming administration. So you could say that may not be a good place to be, or you could turn that around and say there's so much wind in the sails blowing that it's going to overcome that. But initial leadership following election day does not always last. You see there under Trump, 2017 to 2021, what were the leaders? Energy was at the bottom, information technology was at the top. And how about that for Biden, who was a president looking to curtail some of the energy production? Energy was the better performer. So again, initial leadership does not always last. Stay tuned, and where the money where the money will go, where the money will follow. We talked a little bit about the Federal Reserve, their meetings, their insights, their outlook. Mr. Powell, we continue to be confident that with an appropriate, how about that, recalibration of our policy stance, strength in the economy and the labor markets can be maintained with inflation moving sustainably down to 2%. So you remember back in some of our weekly blogs, some of our monthly updates, and just some of our special research we push out, we've talked about we didn't think the inflation rate was going to stay up that 6, 7, 8%. And there on the left, you can see the actual versus the forecast to that Federal Reserve 2% target. And then on the right, you see the Fed funds. That's the short-term interest rates that really controls money market and bank interest rates. How that went up, and we got above 5%. Now that's started to come down. And again, if you look at the forecast, you're looking for money market rates below 4%, which is sort of a wake-up call if you've been able to just hang out in 5% money market thinking, wow, I can live easily on 5%. Well, it's a lot easier to live on 5 than it is 4, a lot easier to live on 4 than it is 3. But again, money market is not an investment, but a good place to park cash when you're going to have some liquidity needs. We expect a few more interest rates through the upcoming year. Hard to say this. Are you getting used to it? 2025. I'm still trying to get my mind around this. Is Thanksgiving coming up next week. So thank you for your time. And as we've said, please feel to reach out with questions or comments. There we are, phone numbers. There we are, email addresses. That's Preston, Tiffany, Maddie, Randy, Matt, and Melissa. The Price Group, we're here for you. And again, as a fiduciary, happy to sit down and give you feedback. We talk to folks on a regular basis. There's no cost or obligation to come by, visit with us. If there's common ground, we'll both know it. If not, we'll shake hands, part as friends, and you will be even a more educated consumer. But we're passionate about what we do, and we'll end with we think everybody needs a wealth coach. So happy Thursday, and more importantly, we wish each of you a blessed Thanksgiving holiday. Each of us has a lot to be thankful for, and we are thankful that you took time to join us today. So until next time, for the Price Group, we bid you again happy Thanksgiving and have a great afternoon.